Your market news now. Asian shares rallied for a fourth consecutive session after markets moved to price in earlier rate cuts in the US and Europe. Meanwhile, oil prices edged higher after shedding 6% last week, drawing support from confirmation Saudi Arabia and Russia will continue their additional voluntary oil output cuts. Locally, commercial property group Redefine said its full-year distributable income fell 4.1%, mainly due to elevated interest rates that increased net funding costs. Its office portfolio continued to benefit from demand from premium grade and well-located property, but it said market rental levels are likely to remain under pressure given a competitive landscape. To talk to us about the latest from a fixed income perspective, we are joined by James Turp, who is a portfolio manager at Sanlam Investments. James, thank you so much for your time. Let's start off by getting a sense of the market, or rather the Rand performance over the past month or so.
Thanks very much for having me, Nastasha. The Rand has recovered substantially from its weakest levels within the last month. The Rand was as weak to the dollar as 1960, so it's down at around 1825 at the moment. So it's definitely got some momentum going in its way. It's bouncing a little bit today, a little bit softer than where it opened, but ultimately the stars have aligned. I guess some global factors have assisted the Rand, but also some domestic ones as well in the form of the medium-term budget. So for now, the Rand looking quite positive, and we hope that this can continue.
Let's look back at last week's market reaction to those FOMC minutes as well as the jobs numbers. What was your take on it?
They both went the same way, didn't they? So you had the FOMC, which the markets interpreted as Jerome Powell being dovish and indicating that enough tightening has seemingly been done, not closing the door on further hikes, but they seem unlikely given the incoming data. So the market interpreting that quite positively. And then, of course, the really important figures that they watch by way of unemployment and non-farm payrolls, which is the amount of jobs that are in the US market, coming in a little softer than expected. So still positive, but less than expected, confirming exactly what the Fed had said, that this economy is starting to cool, not aggressively, and that fits in with the soft landing narrative, and that's so important for investors who are desperately trying to identify now when the first rate cuts begin.
I mean, looking back at the past couple of years, we've seen a lot of criticism come through, especially towards the Fed and, not being able to see that, I suppose, inflation was not as transitory as they thought. What's your perspective now when you look at the Fed's monetary path going forward, seeing that they've become so data dependent? Does it become a problem at some point?
It does, in a way. Of course, the more data dependent, the more volatility, the sort of volatility that we saw around last week's jobs data. So it does make it a little difficult. But I think the main thing is going to be whether they avoid this recession or not that had been so clearly expected for most of this year. And that's on the one side. And the other side is just how sticky inflation remains. Of course, we've got it down to lower levels, but not quite to the target yet. So as you say, each month this data is coming through, adds much more volatility to the market as well. So it's going to make it a little difficult, as always. But the Fed, as you say, their reaction function caught offsides a couple of times. So it's going to remain volatile for the period ahead.
With that said, then, how do you look at the yield curve from here?
Yeah, so if we come back locally, we've had some adjustments on our yield curve. The yield curve flattening. Now, that's as a result pretty much of the medium-term budget and also following global curves that have flattened too. So it's difficult to see on the back of the medium-term budget just how much more we can flatten. There is still increased debt required according to the budget, the consolidation of debt happening a little later and a little higher as a percentage of GDP in the country. And so you probably find that from here, difficult to see much more flattening coming through. And the curve will now probably be determined by expectations on monetary policy from here. And we know, as of this morning, the first interest rate cuts here in South Africa are being priced in about 9 months' time, with inflation still expected to be quite high. We heard from Governor Kganyago last week that the fight against inflation isn't done. So probably still remains a case of higher rates for longer. And that means selectively, you probably want to position in the middle to shorter part of the curve consistently still. And perhaps that long end has done enough, considering we've still got some switch auctions to come.
As we wrap up, what events are you paying attention to for the rest of the week?
There's not too much on a data front this week. We've got some manufacturing, some mining data that'll give us some insight into the health of the economy. But most of the volatility, thankfully, came out last week. So I think this week is going to be a case of, can the rand hold on to the gains? Can bonds hold on to the gains? Does it consolidate and does it continue to move? These are the things we'll be paying attention to closely this week, particularly the currency.
All right, James, thank you so much for your time. That is James Terp, who is a portfolio manager at Sanlam Investments, and looking at the rand just holding above that 18 to the dollar mark. But when we look at our markets in terms of how the JSE is performing, we are seeing the financials weaker by 0.4%. And what's driving us a little bit higher is those resources up about 1.9%. We're going to take a quick break. When we come back, we'll have a look at more of your news. Stay tuned.